Welcome to This Explainer. Okay, today we are tackling something that literally starts fights in finance forums. We're untangling one of the most fiercely debated and honestly heavily misunderstood topics in all of investing, the concept of dividend irrelevance. Look, whether you're a die-hard dividend lover who loves that cash flow or a strict by-the-books index investor, we're going to build a really intuitive mathematical foundation together right now. By the time we're done here, you might just see the stock market in a totally different light. Here is our roadmap for today. We'll start by looking at the great dividend debate. Then we'll break down the actual math of irrelevance. Next, we'll test that math against real-world frictions, analyze actual dividend performance, and wrap it all up with the investor's takeaway. All right, part one, the great dividend debate, a real clash of ideologies. So let's get right into it. In the financial world, there's this massive clash between traditional dividend lovers and academic indexers. And honestly, it all boils down to one central question. Are dividends free money? This is hands down the most common misconception out there in retail investing. People tend to have this mental model that a stock's price grows, and then a dividend is just, a nice little bonus check tossed their way. Like extra cash just magically appearing out of thin air. But to understand why that's mathematically impossible, we really have to look at the economic baseline. Way back in 1961, two Nobel Prize-winning economists, Merton Miller and Franco Modigliani, published what they called the dividend irrelevance theory. Their foundational premise was actually pretty simple. They said, hey, before we factor in messy things like taxes or trading costs, an investor should be completely 100% indifferent to whether a company pays a dividend or not. They proved mathematically that dividends aren't actually a source of investment returns. Instead, paying a dividend is essentially just taking money out of one pocket and moving it right into the other. Moving right along to section 2, the math of irrelevance. Let's strip away the veil. To truly grasp how this works, we need to completely strip away the confusing mechanics of the stock market. Let's make this super concrete. Imagine you own a private convenience store, okay? In its very first year, it generates exactly $1 million in pure profit. Now, you've got two choices. Option A, you take that $1 million straight out of the cash register and pay yourself a dividend. Or, option B, you leave that $1 million sitting inside the business to fund future growth. Well, if you go with option A, sure, you've got $1 million in your hand, but your store is now worth $1 million less because, well, the cash is gone. If you choose option B, you don't have the cash in your hand, but your store is worth exactly $1 million more. Your total net worth is literally identical in both scenarios. The dividend didn't create new wealth, it just changed where your wealth was located. And that brings us to an absolutely unbreakable rule. A $1 dividend out equals exactly a $1 drop in the share price. We actually see this happen mechanically in the real live stock market on what's called the ex-dividend date. On the exact day a stock trades without the value of its next dividend payment attached to it, the stock price drops by the exact amount of that dividend. I mean, it has to. The company literally has less cash on its balance sheet now. So receiving a dividend is mathematically the exact same thing as the stock dropping in value and you just getting that dropped value handed to you in cash. Now, because of this math, you don't actually need a company to pay you a dividend to generate income. You can manufacture your own. It's like a three-step formula. Step 1, you hold shares in a company that doesn't pay a dividend. Step 2, you let the company's profits accumulate inside the business, which drives up the share price. And step 3, when you need cash, you simply sell a proportional number of your shares. You are in total control of the timeline, and the net economic result to your portfolio is absolutely, completely identical to receiving a traditional dividend. Okay, section 3, real-world frictions, theory versus reality. Now, I hear you. You're probably thinking, okay, that's great in a textbook, but we don't live in a theoretical vacuum. And you're totally right. Theory is perfect, but reality is messy. And when we test our model against real-world taxes, it kind of destroys the myth that dividends are universally better. Check out this comparison. Let's say you receive $10,000 in dividends. Depending on where you live, you might get a favorable tax rate, but generally speaking, you are recognizing all $10,000 of those dollars as taxable income immediately. Now compare that to manufacturing your own dividend by selling $10,000 worth of stock. If your original investment had grown by 20%, when you sell those shares, you only pay taxes on the proportional capital gain. In this example, that's just $1,666. Creating your own homemade dividend can actually be wildly more tax efficient simply because you control exactly when you trigger that tax event. But hey, taxes aren't the only friction out there. Human psychology is a massive one. Enter something called the clientele effect. This is a phenomenon where a specific clientele or group of investors buys a stock purely for its dividend yield. And company management knows this. They know that if they cut their dividend, even if it's for a really good, highly logical reason, like heavily investing in an amazing new growth project, these investors will irrationally panic and sell off the stock, causing the price to absolutely plummet. This dynamic forces companies into super inefficient behavior, like literally borrowing money just to maintain a dividend payment that can't actually afford, all just to keep their investors happy. Which naturally brings us to another big real-world friction: agency cost. Put simply, this is the risk that corporate executives, who are supposed to act as the agents for the shareholders, will actually use the company's capital to benefit themselves, rather than the actual owners of the business. Interestingly, this specific friction provides one of the strongest real-world arguments for dividends. On one side of the coin, we have stock buyback abuse. Executives often get paid huge bonuses based on earnings per share metrics. If they use company cash to buy back stock, the total number of shares goes down, which magically makes earnings per share go up, triggering their own bonuses, even if buying back that stock was a terrible use of company money. But on the other side, we have the counter-argument: dividends force prudence. If a company commits to paying a strict dividend, executives have way less free cash lying around to waste on ego-driven vanity projects. The dividend effectively forces them to be highly disciplined with whatever capital they have left. All right, moving to Section 4, explaining dividend performance. So here is the million-dollar question. If dividends mathematically shouldn't matter to total return, why do dividend funds historically perform so incredibly well? Well, the answer lies in something called the Fama-French five-factor model. The empirical evidence shows that when dividend stocks beat the market, they aren't actually doing it because of the dividend. They're doing it because dividend-paying companies tend to share some very specific underlying characteristics. They're usually large-cap stocks, they heavily lean towards value rather than growth, they have really robust profitability, and they invest conservatively. Those underlying factors are what actually drive the outperformance. The dividend itself is just a byproduct. It's kind of like noticing that all the fastest sprinters wear a specific brand of socks and concluding, oh, the socks make them fast, completely ignoring the fact that they all train at the gym 6 days a week. And there is an ultimate danger to purely chasing those dividend yields: the massive opportunity cost. Think about this. Roughly 50% of the companies in the global stock market do not pay a dividend, period. If you set a hard, inflexible rule that you will only invest in dividend pairs, you're arbitrarily cutting your global investment universe literally in half. You are sacrificing immense diversification, which we know increases your risk and the dispersion of your returns, all for a cash flow mechanism that we've already mathematically proven doesn't actually create new wealth. Finally, Section 5, the investor's takeaway. Let's talk about applying these lessons. So, we've covered the theory, the math, the real-world frictions, and the data. How do you actually apply this to your own portfolio? First, we really have to address the elephant in the room. Dividend investors absolutely love to point out that Warren Buffett owns tons of dividend stocks. But, as portfolio manager Ben Felix brilliantly points out, Warren Buffett is happy to collect dividends, but he is a value investor seeking low prices. Buffett isn't out there screening the market purely for dividend yields. He's screening the market for cheap, highly profitable companies that are smartly managed. Those companies just happen to frequently pay dividends. Mistaking that correlation for causation will definitely lead you down a very dangerous investing path. The second big takeaway is recognizing what behavioral economists call the free dividend fallacy. This is a mental accounting bias where we treat our capital gains as this sacred principle that shouldn't be touched, but we treat dividends as free money that's okay to spend. Now, mathematically, we know that's totally flawed because they both come from the exact same pool of total return. However, let's be fair and give credit where it's due. Ironically, for some retirees, this exact mental trick prevents them from panic selling during a massive market crash. It enforces a really strict discipline of only ever spending their yield. So while the math is completely irrelevant, the behavioral psychology of it can sometimes literally be a lifesaver. Which leaves us with one final, pretty provocative thought to really challenge your strategy. Are you picking stocks or are you capturing the market? Because choosing to only buy dividend stocks is, at its core, just another form of active stock picking. You're isolating a specific, narrow slice of the market based purely on a corporate payout policy. Look, whether you ultimately choose to ride the dividend wave or embrace broad total market index funds, understanding the real math behind dividend irrelevance guarantees that you're making that choice with your eyes wide open. Thanks for joining me to figure all this out today on this explainer, and hey, keep that curiosity sharp.